Example CFE exam questions. Let's get started. Under the U.S. Sarbanes-Oxley Act, Section 302 requires which of the following? Is it A, annual external audits of internal controls? Or B, CEO and CFO certification of financial statements and disclosure controls? Could it be C, mandatory whistleblower hotlines for all public companies? Or lastly, D, independent audit committee approval of all fraud investigations? The correct answer is B. Here is why. SOX Section 302 mandates that the CEO and CFO personally certify the accuracy of quarterly and annual financial reports and the effectiveness of internal controls over financial reporting. Option A is related to SOX Section 404. Option C is encouraged but not universally mandated by SOX. Option D is not a requirement of Section 302. Next question. Which of the following is a key element of money laundering under U.S. law, 18 U.S.C. Section 1956? Is it A, placement, layering, and integration? Or B, skimming, concealment, and disbursement? Could it be C, bribery, kickback, and extortion? Or lastly, D, embezzlement, falsification, and rationalization? The correct answer is A. Here is why. While placement, layering, integration describes the process, the key statutory element under 18 U.S.C. Section 1956 involves conducting a financial transaction with proceeds of specified unlawful activity. Knowing the transaction is designed to conceal/disguise the proceeds, avoid reporting, or promote further crime. Among the choices, A is the standard descriptive model. Options B, C, and D describe other types of fraud or schemes. Next question. In a U.S. bankruptcy fraud scheme, concealment of assets most commonly occurs through. Is it A, overstating liabilities? Or B, transferring assets to insiders or related parties pre-filing? Could it be C, inflating revenues in financial statements? Or lastly, D, recording fictitious expenses? The correct answer is B. Here is why. A primary method of bankruptcy fraud is hiding assets from the court and creditors by transferring them to friends, family, or shell companies before filing. Option A, overstating liabilities, is also a method but less common than asset concealment. Options C and D are more typical of financial statement fraud, not specifically bankruptcy fraud. Next question. Under the U.S. False Claims Act, 31 U.S.C. Sections 3729 through 3733, CATAM actions allow. Is it A, government agencies to sue private companies directly? Or B, private citizens to file lawsuits on behalf of the government and share in recoveries? Could it be C, only federal prosecutors to pursue fraud claims? Or lastly, D, companies to self-report fraud without penalties? The correct answer is B. Here is why. CATAM provisions empower private individuals, whistleblowers/relators, to bring lawsuits on behalf of the U.S. government against entities defrauding federal programs. If successful, the relator receives a share of the recovery. Option A describes a direct government suit, not CATAM. Option C is incorrect. Private citizens can sue. Option D describes voluntary disclosure programs, not CATAM. Next question. Which of the following is not a typical red flag of a check tampering scheme? Is it A, missing or altered check endorsements? Or B, frequent voided checks without documentation? Could it be C, vendor addresses matching employee addresses? Or lastly, D, consistent use of the same bank for all disbursements? The correct answer is D. Here is why. Using the same bank is normal business practice and not a red flag. Options A, B, and C are all strong indicators. Altered endorsements suggest forged endorsements, undocumented voided checks may hide stolen checks, and vendor/employee address matches suggest a shell company or forged pay. Next question. In financial statement fraud, channel stuffing refers to: is it A, recording revenue on consignment sales as final? Or B, shipping excess inventory to distributors to inflate sales near period end? Could it be C, understating reserves for bad debts? Or lastly D, capitalizing operating expenses? The correct answer is B. Here is why. Channel stuffing artificially inflates current period revenue by forcing excess product onto distributors, often with generous return rights, to meet sales targets. Option A describes improper revenue recognition on consignment. Option C and D are other methods of earnings manipulation. That's it for today. How many did you score? Let me know in the comments. Please like and subscribe, and tell me what topic I should cover next. Bye.